Hey guys, welcome to Crypto Grid. So before we get started, make sure to hit that like button. Also subscribe to my channel. In this video, I will be discussing what is leverage in crypto trading. In crypto trading, leverage refers to using borrowed capital to make trades. Leverage trading can amplify your buying or selling power, allowing you to trade larger amounts. So even if your initial capital is small, you can use it as collateral to make leverage trades. While leverage trading can multiply your potential profits, it is also subject to high risk, especially in the volatile crypto market. Be careful when using leverage to trade crypto. It may lead to substantial losses if the market moves against your position. Leverage trading can be confusing, especially for beginners. But before experimenting with leverage, it's crucial to understand what it is and how it works. This article will focus on leverage trading in crypto markets. But a great portion of the information is also valid for traditional markets. What is leverage in crypto trading? Leverage refers to using borrowed capital to trade cryptocurrencies or other financial assets. It amplifies your buying or selling power, so you can trade with more capital than what you currently have in your wallet. Depending on the crypto exchange you trade on, you could borrow up to 100 times your account balance. The amount of leverage is described as a ratio, such as 1 to 5, 5x, 110, 10x, or 120, 20x. It shows how many times your initial capital is multiplied. For example, imagine that you have $100 in your exchange account, but want to open a position worth $1,000 in Bitcoin BTC. With a 10x leverage, your $100 will have the same buying power as $1,000. You can use leverage to trade different crypto derivatives. The common types of leverage trading include margin trading, leverage tokens, and futures contracts. How does leverage trading work? Before you can borrow funds and start trading with leverage, you need to deposit funds into your trading account. The initial capital you provide is what we call the collateral. The collateral required depends on the leverage you use and the total value of the position you want to open, known as margin. Say you want to invest $1,000 in Ethereum, ETH, with a 10x leverage. The margin required would be 1/10 of $1,000, meaning that you need to have $100 in your account as collateral for the borrowed funds. If you use a 20x leverage, your required margin would be even lower. 1/20 of $1,000 equals $50. But keep in mind that the higher the leverage, the higher the risks of getting liquidated. Apart from the initial margin deposit, you'll also need to maintain a margin threshold for your trades. When the market moves against your position, and the margin gets lower than the maintenance threshold, you will need to put more funds into your account to avoid being liquidated. The threshold is also known as the maintenance margin. Leverage can be applied to both long and short positions. Opening a long position means that you expect the price of an asset to go up. In contrast, opening a short position means that you believe the price of the asset will fall. While this may sound like regular spot trading, using leverage allows you to buy or sell assets based on your collateral only and not on your holdings. So, even if you don't have an asset, you can still borrow it and sell, open a short position, if you think the market will go lower. Example of a leveraged long position. Imagine you want to open a long position of $10,000 worth of BTC with 10x leverage. This means that you will use $1,000 as collateral. If the price of BTC goes up 20%, you will earn a net profit of $2,000 minus fees, which is much higher than the $200 you would have made if you traded your $1,000 capital without using leverage. However, if the BTC price drops 20%, your position would be down $2,000. Since your initial capital, collateral, is only $1,000, a 20% drop would cause a liquidation. Your balance goes to zero. In fact, you could get liquidated even if the market only drops 10%. The exact liquidation value will depend on the exchange you are using. To avoid being liquidated, you need to add more funds to your wallet to increase your collateral. In most cases, the exchange will send you a margin call before the liquidation happens, an email telling you to add more funds. Why use leverage to trade crypto? As mentioned, traders use leverage to increase their position size and potential profits. But as illustrated by the examples above, leverage trading could also lead to much higher losses. Another reason for traders to use leverage is to enhance the liquidity of their capital. For instance, instead of holding a 2x leveraged position on a single exchange, they could use 4x leverage to maintain the same position size with lower collateral. This would allow them to use the other portion of their money in another place, trading another asset, staking, providing liquidity to decentralized exchanges, DEX, investing in NFTs, etc. How to manage risks with leverage trading? Trading with high leverage might require less capital to start with, but it increases the chances of liquidation. If your leverage is too high, even a 1% price movement could lead to huge losses. The higher the leverage, the smaller your volatility tolerance will be. Using lower leverage gives you more margin of error to trade. This is why Binance and other crypto exchanges have limited the maximum leverage available to new users. Risk management strategies like stop loss and take profit orders help minimize losses in leverage trading. You can use stop loss orders to automatically close your position at a specific price, which is very helpful when the market moves against you. Stop loss orders can protect you from significant losses. Take profit orders are the opposite. They automatically close when your profits reach a certain value. This allows you to secure your earnings before the market condition turns. At this point, it should be clear to you that leverage trading is a double-edged sword that can multiply both your gains and losses exponentially. It involves a high level of risks, especially in the volatile cryptocurrency market. At Binance, we encourage you to trade responsibly by taking accountability for your actions. We offer tools like anti-addiction notice and cooling off period function to help you exercise control over your trades. You should always exercise extreme caution. And don't forget to DYOR to understand how to use leverage properly and plan your trading strategies. How to use margin trading on Binance? You can use leverage to trade cryptocurrencies on crypto exchanges like Binance. We'll show you how to get started on margin trading, but the concept of leverage can also be found in other types of trading. Before we start, you'll need a margin account. Follow this FAQ article to open it if you haven't. 1. Go to Trade, Margin from the top navigation bar. 2. Click on BTC/USDT to search for the pair you want to trade. We're going to use the BNB/USDT pair. 3. You'll also need to transfer funds to your margin wallet. Click Transfer Collaterals below the candlestick chart. 4. Select the wallet to transfer funds, the destination margin account, and the coin to transfer. Enter the amount and click Confirm. In this example, we're transferring 100 USDT to the cross margin account. 5. Now go to the box on the right. Choose either Cross 3x or Isolated 10x. Margin in the cross margin mode is shared among your margin accounts, while the margin in the isolated margin mode is independent for each trading pair. You can read more on the difference between the two from this FAQ article. 6. Select Buy, Long or Sell, Short, and the order type, such as a market order. Click Borrow, and you'll notice that the 100 USDT we transferred to the cross margin account is now multiplied 3x to 300 USDT. 7. You can buy BNB with leverage by entering the amount of USDT by total, or the amount of BNB to buy by amount. You may also drag the bar below to select the percentage of available balance to use. You'll then see the amount you're borrowing for this trade. Click Margin Buy BNB to open the position. Note that you won't be able to use all of your available balance as you need to pay a trading fee. The system will automatically retain the trading fee amount depending on your VIP level. What do you think of our video? Let me know in the comment section below. Thank you for watching.